Asia-Pacific markets are all in the red following an overnight sell-off on Wall Street. The Dow Jones slipped 1.5% and the Nasdaq, the technology-focused index, declined 2.6%, which is its lowest level in 3 months. This is as Treasury yields posted strong gains, with the closely watched 2-year yield breaking above 1% for the first time since February 2020. You will remember that's the month before the pandemic declaration that sent the US economy into recession. Now, in turn, Asia is all painted red, with the Japanese Nikkei down as much as 2.8%. According to analysts, investors around the world are pricing in a more aggressive policy tightening by the Fed based on still high inflation. Now, for more on this story, let's go to Susannah Streeter in Bristol, UK. She's an investment analyst at Hargreaves Lansdown. Susannah, many thanks for being with us today. So technology stocks are kept declining on Tuesday amid interest rates rise. Why are higher interest rates hurting tech stocks in particular? And what sectors, in your opinion, are more immune to potential rate increases?
Well, tech stocks in particular are vulnerable because they are considered high growth stocks, and a lot of their valuation is priced in their future earnings, and in a high yield environment and a high interest rate environment, that reduces the value of those future earnings. So that is why you are seeing falls in tech stocks really right across the board. And it's not just the smaller, really high growth companies, but also the more established names like Apple falling back as well yesterday. And as you say, yes, hitting the Nikkei index, and also the FTSE 100 today. Scottish Mortgage Investment Trust falling by another 2% in early trade. The trust owns big names as part of the holdings such as NIO and Tesla, for example. So that's why it's also been hit by the headwinds of this tech wobble. And it is all linked to expectations that the Federal Reserve will move to raise rates in quick succession this year because the readings of inflation are coming through so hot.
Right, and as you say, I mean, investors are pricing in more rate rises and possibly sooner than expected first hike. What are you pricing in, though? I mean, what are you really expecting on that front?
I do actually think that we will have another interest rate rise from the Bank of England in February, and successive ones after that, certainly by 1% by the end of 2022, perhaps 1.25%. And I think the Fed will move to raise rates in March, again with a number of rate rises to follow through the year. It's already signalled that it's reining in this mass bond buying program, and it depends on whether as well the future readings of inflation is just how quickly it will start offloading those bonds that it has on its balance sheet. And
Susannah, as you rightly say, I mean, tech stocks are high growth stocks and hence why they're tumbling. Just a last question on another sector, the banking sector, because we've seen Goldman Sachs shares tumbling as its operating expenses really surge on increased pay employees with a higher inflation, obviously. I mean, are we expecting this to affect profitability of other banks?
Well, I think certainly as far as Goldman Sachs is concerned, of the contracts it's drawn up with its employees, in particular in terms of those bonuses, it's got to follow through with those. Depends on the bonus level of other banks, but obviously a higher interest rate environment would be good for banks, consumer-focused banks, for example, Lloyds in the UK, because it's really been affected by lower net interest margins, the amount of money that it can make on loans to customers. And so actually that's why you've seen some financials soaring or certainly rising much more robustly than we did during the pandemic, when the ultra low rates really ate into their profit margins. Susannah. So it certainly depends on what type of bank.
Brilliant, Susannah Streeter. Many thanks for that analysis. We'll closely watch the banking sector and the tech sector.